On this month's Market Update, we'll talk about the recently passed tax bill and how it'll impact homeowners.
We will also dive into some of the dynamic changes we're seeing around new construction and existing home sales.
Emerging trends in inflation could be impacting mortgage rates in the second half of this year.
We'll talk about all that and more in this month's Market Update.
Welcome to July's Market Update. I'm your host, Ruben Gonzalez, with my co-host, Gabi.
It's great to be back, Ruben.
Yeah, let's talk tax bill.
Yeah, we've had some changes.
Yeah, so I guess to kick it off, most probably relevant one to homeowners, mortgage interest deduction. What changed?
Yeah.
Really nothing is the answer here. Back in 2017, we had a tax bill passed. It capped the mortgage interest deduction at $750,000 of mortgage, right? So you can deduct up to the interest on $750,000 on your mortgage for homes purchased after 2017. There's a grandfather clause for before that. So, all this stuff, please consult your tax professional, right? We're just giving you the highlights, not the details on how all this stuff is implemented. But essentially, yeah, it's capped at $750,000, and now that cap is kind of for perpetuity. It'll get adjusted in amount as we go forward for things like inflation and that, but for all intents and purposes, we now have this permanently slightly lower cap, right? Because previous to 2017, it was capped at $1 million. All that means is for people purchasing houses, it costs more than $750,000. They're going to be able to deduct a little bit less interest going forward than they could pre-2017. But we've been in that world for a while now, so this really isn't anything super new. It's just not changing.
Yeah, it continues to be advantageous to be a homeowner in the United States.
Yeah. Another big change, we saw an increase in the standard deduction. What does that mean, right? Well, it means fewer people will need to do itemization in their deductions, right? Since that number is now higher, for a single filer, it's almost $16,000. For joint filers, it's about $31,500. That basically means you need to have more than that in deductions, right, before you can itemize. Otherwise, you're there. And for a lot of people, even with the mortgage deduction, it may not be enough to get past that, which will make your taxes a little bit simpler. But it also makes the impact of the mortgage interest deduction a little bit less for a lot of people.
That's right. Yeah. And then there were some positive news for those of us who are real estate investors too.
Yeah. So if you qualify as a professional, so, again, consult your tax professional on what that means. You can continue to deduct 100% depreciation within the first year on real estate, right?
Yeah, so
investment properties.
Yep. An accelerated bonus depreciation.
Yeah, so that can be a really big benefit on your tax bill. I mean, I've talked to people that it's ended up essentially being the down payment they put on their investment property comes back to them in their taxes, essentially. So it can be really advantageous if you're an investor that qualifies for it. And this isn't new. This is an extension. So that was introduced in 2017 also. It was set to expire. Now it's essentially permanent.
Yeah, and it had been tiered to go down year after year. And the good news now is that we are back to 100%.
Yes.
And then there's another great piece of news for those real estate investors about opportunity zones.
Opportunity zones essentially are areas that have a lot of tax benefits if you invest in building new properties or renovating existing properties in those areas. It's kind of designed to help renovate areas that maybe economically have been more depressed over the last several years. It's state by state where those areas are. Governors get to choose them. So again, consult your tax professional on how that might benefit you. It's usually going to be people doing larger investment projects for that case.
Yeah. And it gives an opportunity for cities to be able to create more affordable housing. And as a real estate professional, an investor, that can be an incredible opportunity to build some wealth by also helping cities to gentrify those areas.
So another big one is the state and local tax, which is SALT, right? So that's things like state income tax, your sales taxes, most local taxes that you pay inside your state or your city that aren't federal. So that deduction has gone now from $10,000 up to $40,000. Quite significant.
That's a big change.
Yeah, so that's going to impact a lot of people in places with high income taxes from their states and their cities. People with high property taxes as well. Now, you'll get more of a deduction there potentially, especially for more expensive properties where you are pushing past that $10,000 in property taxes, right? So that's another big one. It does phase out for those who earn over 600. If you earn over $600,000, you're only going to get the $10,000 deduction. But for the rest of us, you get up to $40,000 now. The last one really is, if you are looking at doing renovations around energy efficiency, a lot of those tax credits are going away at the end of 2025.
So now is the time.
Exactly. You've got 6 months to get that figured out if you want to get those tax credits. So, I would say, again, consult your tax professional and do your research. And, you've got, the rest of this year to get that through.
Yeah. So now may be the time to add those solar panels to properties or create some efficiency around HVACs, windows, so that you can make sure that you're taking advantage of that credit before it goes to sunset at the end of the year.
Yeah. So, housing market, right?
Yeah.
Let's move on. It was an interesting month. When I was looking at the numbers, going into this, I was expecting to see a little bit of a uptick in June. And if you look at the seasonally unadjusted numbers, we did see about a 4% increase in sales. But when they adjusted it for seasonality, accounting for things like the number of, weekdays in a month and things like that, they essentially have it as flat. So compared to last year, 0% change in June, which is a little bit challenging because last year was not a great year in the summer, right? We were dealing with rising mortgage rates. It slowed sales down a lot. We're kind of continuing at that sort of anemic pace right now. We're seeing a lot of different trends around the market. Inventory has been building. We were at 4.7 months supply, the highest we've seen since 2016. Prices were actually up a bit, at 2%. It's still below the 4% that's more normal, right? But we're kind of shifting towards a buyer's market, I'll say. I wouldn't say we're in a buyer's market yet at 4.7 months.
It feels like a creep.
Yeah, we're getting in that direction though, right? So the pressure on prices is reducing, but it's still positive. There's a lot of interesting dynamics as well. One thing we're watching is the percentage of homes with price decreases. That's at the highest level it's been since the pandemic. When we look at, the nation, we're at about, I believe, 28% of all listings had price decreases in June. That's a pretty hefty amount. But when you look by state, there's several states with much higher than that. The top 5 states for price decreases right now are Arizona, Colorado, Texas, Florida, and Tennessee, and they're all above 45% of listings who have had price decreases.
That's pretty significant too. And what surprised us too was the number of properties that end up getting delisted, or another way of putting it is to get withdrawn. Talk to us about that, Ruben. That was a significant change.
Yeah, according to a study from Realtor.com that recently came out, the number of homes that were withdrawn from the market, meaning they didn't expire, but the listing was removed, increased by 47% year over year.
That's
right?
A significant change.
Yeah. So some of that's just, with more inventory comes more withdrawals. Just a bigger pie, the slices increase, right? But it's more than the growth in inventory, right? So we are seeing an increased pace there. It's to me, it's an interesting dynamic because what it tells me is that there's likely some contingent of sellers out there, right, that essentially maybe have and it's probably true of all sellers to some extent, but they're acting on it in a very real way right now, like a reserve price in their mind. They're interested in selling, but as long as they can get a certain price, their motivation may be not as high as traditionally has been the case over the last few years. So when they realize they're not going to get that price, it seems like they're just removing their listing from the market, right? Rather than taking I'm going to leave it on, wait and see approach and let the house sit there. There are plenty of houses that are sitting there. We're seeing that, a dynamic we're seeing is that there are a contingent of homes that sit on the market for quite a while. You've kind of got clustering around the median days on market, which in a lot of places between 30 and 40 right now. But then you've got these strong, what we call a right tail in the distribution, which means there's a stacking up of homes as outliers. So homes that are sitting 90 plus days potentially in a lot of markets that are driving up the average days on markets in a lot of places, even though the majority of homes are still clustered kind of around that median. So it's an interesting dynamic because you've got these sort of subsets of sellers, some motivated sellers, but that have unappealing listings that are going to sit on the market a long time.
Yeah, those are the sellers that were serious and in a hurry and didn't price the property correctly coming out of the gate. And then we are also seeing those sellers that are serious and not in a hurry, right? They may have had motivation. It would be nice to move, and yet they're not making the move anymore.
Yeah, and you've got those that are kind of I'd like to get the money, right? They're it seems like a good time, but if I can't get it, I've got a 2.7% mortgage rate. My payment's really good. if I can't get at least X amount out of the house right now, I'll wait another year. I'll wait 2 years. Maybe I'd never sell. It's that kind of dynamic right now where, because the market's so soft, you're seeing a real mix. So the listing market, I guess, has gotten a little bit more complex.
We are seeing that softness translated into the new construction sector as well.
Yeah. So, we've also seen research showing that, 37% of builders are doing price reductions right now. More than half of builders are also offering incentives. We're seeing a lot of things there where you're now competing more with new construction directly than maybe was common in the past. I've also seen some research recently out of the Texas Real Estate Center at A&M that showed essentially that the gap between the price of a median new home and a median existing home is at the lowest level it's been quite some time. So I think it was around 6% now, where in the past it had been as much as 20+%. So at comparable houses, you're now at comparable prices a lot of times with new construction, and depending on geography and things like that, in a lot of cases your listings may be competing directly with a new home in a new community.
Yeah, and that shift in the way that new construction sales are trending downward, and with builders offering incentives much more than we have seen over the last couple of years, it may give a listing agent and also a home seller really good indicators for future pricing strategies. If you are living in a market where you are noticing that those are the trends in new construction, take note of it, because if you have your property listed on the market right now, you may want to consider following suit with similar strategies so that your resale home remains competitive.
Yeah, you have to consider, right? Like, if I'm kind of comping with new construction, what does that mean? Because obviously it's not necessarily apples to apples. Like, where do I need to be priced in consideration if there's a new home that's listed at a similar price in the relatively close proximity to my listing, right?
That's right. That's right. And if you happen to be a home seller that has their home on the market right now and it is sitting, that you might want to take a look at 1, 2, or 3 strategies that, as you're thinking about not just price adjustments, right, to be competitive in the price band in which you are listed, but to think about what concessions might look like to make your home more appealing to buyers. Concessions can look like remodeling credits offered to paying part of the closing costs for the buyer. Things that your real estate professional can consult you on that will make your property stand out beyond the initial list price that was agreed upon.
So speaking of prices, let's talk about inflation. I think there's some important trends starting to maybe emerge that could be impacting us for the rest of the year. So this last month, we saw both inflation metrics increase in the CPI. So both the headline CPI, as we call it, basic CPI, and the core CPI, which is CPI minus food and energy, which is something that economists kind of look at as a little bit more stable indicator of what prices are doing. So we saw the CPI increase to 2.7% and the core CPI increase to 2.9%. Why does it matter? Aside from just the fact that, it makes things more challenging when things are getting more expensive for people to budget and things like that. On our end, for things like mortgage rates, it's important because it's going to impact Fed decisions. And even more importantly than just the Fed decisions, people's expectations about inflation in the future, and that kind of translating into long-term interest rates in a way. It impacts mortgage rates directly. Right now, it's not necessarily a trend yet. We did see indications that some of this is being driven by things like tariffs. So if we see some of that kind of uncertainty around tariffs alleviated, it could make this a blip rather than a trend. But we have to watch it because it does seem like, we're still talking about tariffs. There's still deals being negotiated. And we're starting to potentially see some of the first impacts on prices driven there. Some notable things we saw were things like laundry machines. The price of those was up almost 8% year over year. That's something that's frequently manufactured overseas and imported, right? The price of books, like college textbooks, was up 10%. A lot of printing is done overseas. Another one I noted was car insurance was up quite a bit. And, one of the things that impacts car insurance prices you may not think of is like the cost of the parts to put on a car, and like things like plastic bumpers that are frequently manufactured in Asia and other places. Insurance companies have to account for that, and they have to account for that trend going forward as well. So it's all these things are starting to show up to kind of give us the first inklings of how inflation may impact prices. Where that comes into play with the Fed is, they'll tolerate a little bit of like a little jump, like a blip. What they want to avoid is, like this ingrained inflation trend setting in where we're moving back toward 3+ % inflation on a regular basis, because it gets much more difficult to break that pattern once it becomes a pattern. That's going to make them much more hesitant to lower their base rates. That's going to keep mortgage rates potentially kind of at the elevated level they are now. If we are kind of like seeing this inflation number continue to tick up, it's basically going to make it's kind of justified the Fed's hesitancy to lower rates.
And the challenge could become, between the increase of consumer goods that will continue to go up for the foreseeable future and the lack of interest rates going down, that it tightens affordability for someone to be able to save for a down payment of a home.
Yeah, absolutely. We've seen the impact heavily on first-time buyers, right? That's the contingent that their savings has to usually be in cash rather than being able to use things like equity. They're more sensitive to mortgage rates because they're dealing with tighter budgets. So yeah, that cohort is going to continue to be the most heavily impacted here. We see interest rates probably staying in the range they've been in for the rest of the year at this point. We're looking at, we're at 6.8% right now. It's been that way for a while. Probably going to continue to be between 6.5% and 7%, most likely in that 6.8% territory.
Yeah. And one creative way that someone who may be a first-time home buyer, still in the market, still motivated of wanting to make a purchase, might consider consulting with their real estate professional around, is to get an idea of loan assumptions. There are lots of home sellers that may be on the market today where it may not be obvious in the multiple listing service that they have a listing available where a loan assumption might be possible for a rate for less than 6.8%. And one way to do that is to begin the conversation with the real estate professional that is representing you to make sure that is one of the communications that they have with the listing agents on properties that might be of interest. It does still happen, and when it happens, it's such a delight for both parties of the transaction, for those sellers too that want to make a move and that may not have known that that's an option for them to pursue to increase the buyer pool.
Yeah, absolutely. And like on the listing side, being able to advertise an assumable mortgage on a listing would be very appealing, right? 'Cause now you're not just buying a house, you're buying a lower payment than you could get elsewhere.
It's a hidden feature of the home, really.
Exactly. It's also, I think, important that, people discuss the implications of that for the seller as well, right? Because there's certain types of assumable mortgages that you're kind of like giving up opportunities for the type of mortgage you can get on your next home when you let someone assume it, right? Like with VA loans, there's specific rules around what that means for you going forward as long as that person has your previous mortgage, right? But it is a way to like really increase the marketability of a home if you've got an assumable mortgage, and also like a good strategy as a buyer to go hunt for those assumable mortgages where you can find them to get a lower rate.
That's exactly right.
But yeah, like big picture, rates are kind of where they are likely to remain, at least for the near future. We'll see, there's still a lot of uncertainty that can move things around, but, as things remain at this moment, I think we're going to be living in this sort of like upper 6% territory, at least for the next several months. So, final takeaways.
The good news for homeowners and for real estate professionals is that the legislative changes are advantageous for those who love to invest in real estate. Of course, as always, consult with your tax professionals. The good news is this time of year, right around mid-year, is the perfect time to be able to sit down and discuss what some of those changes may look like for the advantage of your tax bill this year. I think one of the most important pieces for an existing homeowner or someone who is already invested in real estate will be this idea that we have about half a year left until some of the energy tax credits will sunset. And the good news is that that should give us plenty of time to be able to make those energy efficient updates or maybe to add those solar panels now. And as we're looking at the new construction and existing home sales, that we want to start paying attention on what is happening in our local markets as it comes to incentives. New construction home sales are definitely a competitor right now. And if you are a seller right now looking to sell your property, that you may want to take a look at what some of these strategies are that you too want to implement to make your home more competitive. Finally, mortgage rates are probably not going to adjust a whole lot down, right? They have continued to remain relatively flat, and indicators are showing us that that may continue to be the case between now and certainly the end of the year. So if a buyer remains motivated to purchase a property now, they should probably not delay based on mortgage interest rates because they will remain the same.
Yeah, you nailed it. Always great being here with you, Gabi.
Always a pleasure being here with you, Ruben.
Yeah, And thank you all for joining us for this month's market update. For those of you who are real estate professionals, I hope to see you at Mega Camp this coming month. And for the rest of you, I hope you join us again. We'll discuss a lot of the same topics. We'll dive into the details on next month's market update.
Until next time, we look forward to having you with us.